As the World Cup captivates football fans with teams battling through each round for the ultimate prize, another contest is playing out on the geoeconomic field. As we reach mid-year and the halfway point of the 2020s, it is apt to take a half-time pause and ask, who is winning, who is losing, and how might strategies shift in the second half of the year and the rest of the decade? Unlike football with its fixed rules and referees, the rules-based geoeconomic order is fading, and it is increasingly unclear who, if anyone, is officiating. At halftime in 2026, the winning 11 includes plays such as Elon Musk's SpaceX, Jensen Huang's Nvidia, the artificial intelligence era, Aliko Dangote, a rising China, aerospace and defense industries, non-Middle East oil exporters, Wall Street, the US dollar, socialists gaining ground in US politics, and Africa's economic integration. SpaceX, powered by Starlink and reusable rockets, is opening up space and positioning itself for major US government contracts as the race shifts to low Earth orbit. Nvidia, led by Jensen Huang, remains the flagship supplier of must-have graphic processing units and the vital engines needed in the artificial intelligence world. After the early hype and more of spend and promise, AI revenues are accelerating as the technology reshapes productivity and strategic advantage across sectors such as defense, finance, and medical research. In the first half of 2026, Aliko Dangote defied the odds by helping shift Nigeria from crude exporter to refined product exporter, a major step for African industrialization. China is scoring goals using overcapacity, electric vehicles, batteries, solar, ports, BRICS, that's the alliance of third world emerging economies, and non-dollar trade to press ahead as the fragmented West plays defense. The defense and aerospace sector is another emerging star on the pitch. The European Union's investment arm is lending $3.4 billion to Airbus to support defense investments and reduce reliance on the US and China. Airbus is also seeking approval to merge with Leonardo and Thales, two European defense firms, to expand presence in the space industry. Other first-half winners include Wall Street, lifted by volatility, liquidity, artificial intelligence enthusiasm, and strong trading activity. Non-Middle East exporters such as the US, Guyana, Brazil, Canada, Norway, Nigeria, and Angola, which are gaining market share as Middle East supply remains constrained. The US dollar, another winner, which remains dominant despite de-dollarization talk, and Africa's integration drivers with the AfCFTA, that's the Africa Continental Free Trade Area, cross-border trade and infrastructure corridors continue to gather momentum. Ajibola Olomola, partner at KPMG, shares his perspective on the first half of the year and the key forces shaping it. As he focuses on the Nigerian economy, Ajibola says we are not out of the woods, and Nigerians are rightly concerned about the impact of the reforms that are ongoing on the man in the street. A lot more thinking, he says, is required to keep Nigerians on side while the reforms are allowed to take root for the overall benefit of all citizens.
Most analysts indicate that it's been a period of growth for the country, strong growth, if you might say. We've seen for 2025, for example, annual real GDP growth of about 3.87%, up from 3.38%. This is important because if you were to track nominal GDP, which is what people who advance credit would be focused on, that foreign portfolio investors, if you care, or banks, and so on and so forth, Nominal GDP is growing at almost 18% per annum. That tells you that Nigeria is doing something right on the macro side. This momentum has been sustained in 2026 so far. The results for Q1 2026 shows the economy expanding by about 3.89% year on year compared to the same figures in Q1 2025. So in Q1 2025 it was 3.13%, and in Q1 2026 we're growing at 3.89%. That again is a testimony of growth in the economy. You can also take another indication from the stock market. The Nigerian equities market ended in 2025 on an exceptionally strong note, posting one of the best annual gains in recent times, about 51.2%. The year-to-date performance in 2026 has been equally strong, about 55.7%, albeit at a recently subdued pace. The NGX All Share Index closed at 241,948.80 index points, and market capitalization stands at 155.21 trillion. All these indicators show, and I'll add one more before I tell you what the global rating agencies are saying to us. They show that Nigeria has been able to reduce its debt to revenue ratio from 95% in 2023 May today to 67% in 2025 December. The budgeted debt to revenue ratio for Nigeria is 50% at the end of 2026. So when we circle back at the end of the year, we'll see how well Nigeria has performed relative to that indicator. That indicator is very important because it is what global rating agencies also look at, together with the growth in nominal GDP and real GDP, in determining whether the economy is strong or resilient or whether it is investable. And so S&P Global recently upgraded Nigeria ratings to a B. A B is a strong rating. It's not exactly investable quite yet, but it shows a lot of improvement from junk status. And let me not name the countries that have recently gotten into junk status. This is not the time or place for that. But the important thing is to say that Nigeria appears to be going in the right direction. The previous upgrades were from B minus and Moody's B3 and Fitch B in 2025. B minus and Moody's B3 and Fitch B in 2025. So we see a clear positive growth in the economy. But when you go to the streets, what you keep hearing is people are not feeling it. But before I tell you why I think people are not feeling it, let's look at the tax numbers. Because like you know, Nigeria made a huge bet in 2025 on a new tax reform, which produced a new set of legislation called the Nigeria Tax Act. This act came into effect on the 1st of January 2026, and so we're in the implementation phase at the moment. You may have recalled that time when the Minister for Finance was quoted as saying last week that the initial revenue accretion to the federal government for 2026 has been a bit low. When you look at the company's income tax numbers, the variance is about 1.3 trillion negative. Performance rate is about 74.25%. If you look at the upstream company's income tax, the performance rate is about 66.91%, and the variance of negative 173 billion. Petroleum royalties, and so on and so forth. The numbers have tracked negatively against budget. But that's also because the government in that bill has given quite a lot away to taxpayers. So you can expect that there will be diminished revenue accretion to the government on the tax side. Trickle-down economics. That's how people are going to get direct impact of all these reforms. One of the aspects of trickle-down economy, of course, is a reduced tax burden. And most companies, most individuals are reporting a reduction in their tax rates. That tells you that people are beginning to feel the impact of these changes in their pockets. But a lot more work has to be done around structured employment, PMI indexes, and just getting people to the last mile.
Hello, and welcome to Global Business Insight, where we bring perspectives to help you navigate today's more complex terrain. Let's also look at the losing plays, that is, those on the back foot so far in the first half. First, the casualties of war, citizens in Iran, Ukraine, and Russia who suffered from attacks, sanctions, capital flight, infrastructure damage, development inertia, and heavy human costs. Africa's poor also lost out as food and fuel inflation, debt burdens, and weak job creation held back inclusive growth, and poverty rose. A divided America weakened its long-term planning and vision, while UK Prime Minister Keir Starmer retired as he succumbed to a crippling stagflation and limited fiscal room. The question is whether Andy Burnham's regional devolution agenda offers a stronger alternative. South African xenophobia is another own goal, undermining investor confidence and regional integration needed for the continent's renaissance. Other losers in the first half include central banks battling sticky inflation, the Democratic Republic of Congo facing Ebola amid aid cuts, and Europe's record heat wave, which is hitting productivity, agriculture, and public health. The final losing players are movements, you could say, losing momentum, like anti-corruption, non-governmental organizations, climate activism, and DEI, diversity, equity, and inclusion, especially as U.S. companies roll back commitments in this space. At halftime, some players need new strategies, though many trajectories may not change. The second half is also likely to center on three main themes. First is technology sovereignty across artificial intelligence, chips, and energy, illustrated by China's tighter export controls just announced on Japanese entities. Second is the balance between fragmentation and integration. To watch includes what happens there with US-China trade tensions, BRICS, UK-EU ties, and how a fragile US-Iran deal could reshape Middle East power dynamics. The biggest potential global game changer in 2026 remains the US midterms. Globally, the third theme is the rise in cost of living politics as affordability in housing, energy, and food becomes the decisive political lever that makes all the difference to voters, whether in New York or in Lagos. Yesterday, the Dow Jones Industrial Average rose to a fresh record close as a fragile pause in hostilities between the US and Iran lifted sentiment, and US indexes set to make strong quarter-on-quarter gains. The price of gold was, however, down below $4,000 a troy ounce as it headed for its worst quarterly performance in over a decade. We also saw a striking rotation as the Magnificent Seven megatech stocks were down more than $2.3 trillion of value this month, as investors favored the chip makers more likely to benefit from the huge capital spend in the tech sector. Today, Asia-Pacific markets were mixed in afternoon trade, tracking gains on Wall Street overnight. Japan's Nikkei is, however, set for a record rise of more than 38% for the quarter, while South Korea's chipmaker-driven Kospi was set for a spectacular second quarter rise of nearly 71%, having more than doubled year to date. Analysts now say the oil market's worries about war in Iran have receded into memory much quicker than anyone thought, with benchmark Brent crude futures at pre-war prices of $72.5 a barrel, down over 20% in June, despite the uncertainty around an interim ceasefire. Well, that's it on this special episode of Global Business Insights as we close the first half of the year. We are now on Spotify, Apple, YouTube podcasts, and most popular platforms where you get your podcasts from. This is Bodio Shosami. Thanks for watching. Bye-bye.